You know what nobody's talking about? While everyone's been distracted by the latest headlines, something massive just happened in the gold market. And I'm not talking about another price spike or some analyst's prediction. I'm talking about a fundamental shift in how the global financial system operates. Central banks just crossed a threshold that changes everything, and if you're holding dollars, retirement accounts, or any traditional assets right now, you need to understand what this means for your wealth in the next 12 to 18 months. Let me show you what's really happening behind the scenes. For decades, central banks were net sellers of gold. They'd accumulated massive reserves during the gold standard era, and once Nixon closed the gold window, they started dumping it. The narrative was simple. Gold is a barbarous relic. Modern economies don't need it. We've got sophisticated monetary policy now. The Bank of England famously sold half its gold reserves between 1999 and 2002 at around $275 an ounce. Gordon Brown, the chancellor at the time, thought he was being clever, diversifying into productive assets. That decision cost the British taxpayer billions. They call it Brown's bottom now. But something changed after 2008. Quietly at first, then dramatically. Central banks stopped selling. They started buying, not just buying a little here and there for diversification, buying aggressively, buying at levels we haven't seen since the 1960s. And here's where it gets interesting. The buying accelerated massively starting in 2022. Net central bank gold purchases more than doubled, surpassing 1,000 tons annually. That's not a typo. Over 1,000 tons per year. To put that in perspective, that's roughly 40% of annual mine production being absorbed by central banks alone. Who's buying? China, Russia, India, Turkey, Poland, Singapore, the Philippines, even countries you wouldn't expect. These aren't random purchases. This is coordinated de-dollarization. Now the mainstream financial media will tell you this is about diversification, risk management, standard central bank operations. But that explanation doesn't hold up when you look at the scale and urgency of what's happening. Let me walk you through what I discovered when I started digging into the actual data. The People's Bank of China reported adding to their gold reserves for 18 consecutive months through mid-2024. 18 months straight. Every single month. And here's the thing. Most analysts believe China's official numbers are understated. They're likely holding far more than they're reporting. Why would they underreport? Because if the market knew the true scale of their accumulation, gold would already be at $5,000 or $6,000 an ounce. They're trying to accumulate as much as possible before the price runs away from them. Russia's been even more aggressive. After the sanctions hit in 2022, they went all in on gold. They're not just buying it. They're mining it domestically, refining it, and storing it in vaults that Western governments can't touch. They learned their lesson when $300 billion of their foreign exchange reserves got frozen overnight. Think about that for a second. $300 billion. Just gone. Inaccessible. Because it was held in dollars and euros in Western financial institutions. That's when the light bulb went off for every central bank watching. If it can happen to Russia, it can happen to anyone. Your dollar reserves aren't really yours if they can be frozen with the stroke of a pen. So what's the alternative? Gold. Physical gold. In your own vaults. Under your own control. This is what the Great Reset actually looks like. Not some conspiracy theory. Not Klaus Schwab's vision. The real reset is happening in central bank vaults right now. It's a reset away from dollar dominance, away from a system where one country controls the global reserve currency. And the evidence is everywhere once you know where to look. The BRICS nations, Brazil, Russia, India, China, South Africa, have been openly discussing a gold-backed trade settlement system. They're not talking about replacing the dollar tomorrow. They're talking about creating an alternative. A parallel system where trade can be settled without dollars. Saudi Arabia let their 50-year petrodollar agreement with the United States expire. 50 years. That agreement, signed in 1974, was the foundation of dollar dominance. Saudi oil priced in dollars. Dollars recycled into U.S. treasuries. That's what made the dollar the global reserve currency. Now, the Saudis are accepting yuan for oil sales to China. They're talking about joining BRICS. They're diversifying away from dollars. The United Arab Emirates is stockpiling gold. Singapore's building massive vault capacity. Even Poland, a NATO member, repatriated 100 tons of gold from the Bank of England. They want it home, in Warsaw, where they can see it. This isn't normal central bank behavior. This is preparation. But here's what really caught my attention. The price action in gold doesn't match what you'd expect from this level of buying pressure. Think about it. Central banks buying over 1,000 tons per year. That's institutional demand on a scale that should be driving prices through the roof. And yet, for months, gold was trading in a relatively tight range. Consolidating. Building a base. How is that possible? How can you have record institutional buying and relatively stable prices? The answer is the paper gold market, the COMEX futures market, the London Bullion Market Association. These are markets where gold is traded on paper, contracts, derivatives, not physical metal. The ratio of paper gold to physical gold is estimated to be somewhere between 100 to 1 and 250 to 1. For every ounce of physical gold that actually exists, there are 100 to 250 paper claims on that same ounce. As long as everyone's happy trading paper, the system works. Prices can be managed. Volatility can be controlled. But what happens when people start asking for physical delivery? That's the squeeze everyone's watching for. And there are signs it's already starting. Premiums on physical gold coins and bars have been elevated for months. The spread between paper gold prices and physical gold prices has been widening. Delivery times are extending. Some dealers are struggling to source inventory. The Shanghai Gold Exchange, where physical delivery is required, has been trading at a premium to COMEX and LBMA prices. That premium is telling you something. It's telling you that in markets where you have to deliver real metal, the price is higher. Now let's talk about what this means for regular investors, for people with retirement accounts, for anyone trying to preserve wealth in this environment. The traditional 60-40 portfolio, 60% stocks, 40% bonds, was built for a different era, an era of stable currencies, predictable inflation, central banks that followed rules. That era is over. We're in a world where central banks are printing trillions, where government debt is exploding, where the currency itself is being debased. In that world, you need real assets, assets that can't be printed, assets that have held value for thousands of years. Gold is the obvious choice. But here's what most people get wrong. They think of gold as an investment, something that should generate returns, pay dividends, grow earnings. That's not what gold is. Gold is insurance. It's a hedge against monetary chaos, against currency debasement, against the kind of systemic risks we're seeing build up right now. And the insurance is getting more expensive, because more people are waking up to the risks. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, how the custodian system works, what the fees look like. Worth checking out if that's relevant to your situation. Anyway, back to where this price is headed next. When you look at gold's price history, there are clear patterns. Gold doesn't move in straight lines. It moves in long cycles. Decade-long bull markets, followed by decade-long bear markets. The last major bull market ran from 2001 to 2011. Gold went from $250 to $1,900, a nearly eightfold increase. That bull market was driven by the aftermath of the dot-com bubble, the housing crisis, quantitative easing, and concerns about dollar debasement. Then came the bear market. From 2011 to 2015, gold fell from $1,900 to $1,050. Everyone declared the gold bull market dead. Central banks were going to normalize policy. Inflation was under control. The dollar was strong. But starting in 2016, something changed. Gold started building a base, consolidating. And then in 2019, it broke out. It took out the old highs in 2020, hitting $2,070. Then it consolidated again for 3 years. Now we're in the next leg up. And this one looks different. This one has the fundamental support of central bank buying, of de-dollarization, of a global monetary system in transition. Some analysts are calling for 3,000 gold in the near term. Others are talking about $5,000. A few are even suggesting $10,000 or higher if we see a real currency crisis. I don't make price predictions, but I will tell you this. The setup today looks more compelling than anything we saw in the 2000s bull market. The fundamental drivers are stronger, the risks are greater, and the awareness is still relatively low. Most investors still have zero exposure to gold. Most financial advisors still recommend little to no gold allocation. The mainstream narrative is still that gold is a barbarous relic. That's actually bullish, because it means we're still early. The real move happens when everyone figures it out at the same time, when pension funds start allocating, when sovereign wealth funds go all in, when retail investors panic into safety. Let me give you a historical parallel. In 1971, when Nixon closed the gold window, gold was $35 an ounce. By 1980, it hit $850. That's a 24-fold increase in 9 years. What drove that move? Loss of confidence in the dollar, inflation, geopolitical instability, oil shocks. Sound familiar? The difference today is the scale. In 1971, U.S. government debt was under $400 billion. Today, it's over $36 trillion. In 1971, the Fed's balance sheet was tiny. Today, it's measured in trillions. The monetary expansion we've seen since 2008 dwarfs anything from the 1970s, and yet gold is only at $4,000. If you adjust the 1980 peak for real inflation using honest inflation metrics, gold should already be at $15,000 to $20,000 an ounce just to match that previous high. That's the great gold reset theory some analysts are talking about. The idea that gold needs to be revalued significantly higher to reflect the true level of currency debasement that's occurred. Whether that happens or not, I don't know. But the direction is clear, the trend is clear, and the smart money is positioning accordingly. Here's what I'm watching closely. The COMEX gold inventories. These are the physical gold stocks held in COMEX warehouses that back the futures contracts. Those inventories have been declining, not dramatically, but steadily. If we see a sharp drop in COMEX inventories, that's a red flag. It means people are taking delivery. It means the paper market is being tested. And if the paper market breaks, if there's a delivery failure or a force majeure event, gold could gap up violently. The other thing I'm watching is the gold to silver ratio. Historically, this ratio has been around 15 to 1 or 20 to 1. Today, it's around 80 to 1. That's telling you silver is extremely undervalued relative to gold. When gold starts its major moves, silver typically follows with even more volatility. If gold goes to $5,000, silver could easily hit $100 or more. That's a 2x to 3x move from current levels, 3x. But silver is more volatile, more industrial, more speculative. Gold is the anchor, the foundation, the asset you hold for wealth preservation. Now, let's talk about the risks, because nothing goes up in a straight line, and there are always scenarios where things don't play out as expected. The biggest risk to gold is a genuine return to sound monetary policy. If central banks actually stopped printing money, if governments actually got their fiscal houses in order, if we saw real austerity and debt reduction, that would be bearish for gold. But does anyone seriously believe that's going to happen? With debt levels this high? With entitlement obligations exploding? With political pressure to spend more, not less? The path of least resistance is more money printing, more debt monetization, more currency debasement. And that's the environment where gold thrives. The other risk is a deflationary collapse, a 2008-style credit crisis where everything gets sold, including gold, to raise cash. We saw that briefly in March 2020. Gold dropped from $1,700 to $1,450 in a matter of weeks. But notice what happened next. Gold recovered within months and went on to make new all-time highs. Because the central bank response to deflation is always the same: print more money. And that's bullish for gold. So even the deflationary scenario is ultimately bullish for gold. It might create a short-term buying opportunity, but the long-term trend remains intact. Here's the bottom line. We're witnessing a historic shift in the global monetary system. Central banks are voting with their reserves. They're moving away from dollars and into gold, not because they want to, because they have to. The trust that underpinned the dollar system is breaking down. The weaponization of the dollar through sanctions showed everyone that dollar reserves aren't safe. The massive money printing showed everyone that the dollar's purchasing power isn't stable. Gold is the alternative. It's the asset that can't be printed, can't be frozen, can't be devalued by central bank policy. It's the ultimate form of monetary sovereignty. And as more central banks figure this out, as more investors figure this out, the demand for physical gold is going to overwhelm the available supply. The paper gold market is going to be tested, and prices are going to adjust to reflect the new reality. This isn't a trade. This isn't something you buy today and sell next month. This is a multi-year repositioning, a structural shift, and the early movers are going to benefit the most. The central banks are already positioned. The sovereign wealth funds are accumulating. The ultra-wealthy have been buying for years. The question is, when does everyone else figure it out? Because once the crowd realizes what's happening, once there's a rush for physical metal, it'll be too late to get in at reasonable prices. The premiums will explode, the availability will dry up, and you'll be competing with institutions that have far deeper pockets. That's the urgency here. Not because gold is going to double tomorrow, But because the window to position yourself ahead of the crowd is closing, the smart money has already moved. The question is whether you're going to join them or wait until it's obvious to everyone. And by the time it's obvious to everyone, the opportunity is gone. Look at what happened with Bitcoin. For years, people dismissed it, called it a scam, said it had no value. Then institutions started buying. Then countries started adopting it. And the price went from $1,000 to $60,000. The people who bought at $1,000 looked crazy at the time. The people who bought at $60,000 wish they'd bought at $1,000. Gold is different from Bitcoin. It's been money for 5,000 years. It's not speculative. It's not a technology bet. It's the ultimate safe haven. But the principle is the same. The time to position yourself is before everyone else figures it out. Right now, we're in that window. Central banks know. Sovereign wealth funds know. The ultra-wealthy know. But the average investor? Still skeptical. Still waiting for confirmation. Still listening to financial advisors who have zero gold allocation in their model portfolios. That's your opportunity. That's the edge. Being willing to position yourself based on the fundamentals, not the crowd sentiment. Because the fundamentals are screaming. Record central bank buying. De-dollarization accelerating. Currency debasement continuing. Geopolitical instability rising. Debt levels exploding. All of these are bullish for gold. The only question is how high it goes and how fast. And that depends on how quickly the crowd wakes up, how quickly the trust in the current system erodes, how quickly the paper gold market gets tested. My guess, faster than most people expect. Because these transitions always happen faster than anyone thinks possible. The status quo seems stable right until it isn't. And then everything changes overnight. We saw it in 2008. We saw it in 2020. We'll see it again. And when we do, the assets that benefit will move violently. Gold will be one of them. So the question you need to ask yourself is simple. Are you positioned for what's coming, or are you still holding assets that depend on the current system remaining stable? Because if you're betting on stability, you're betting against every major central bank in the world. You're betting against the clear trend of de-dollarization. You're betting against thousands of years of monetary history. That's not a bet I'd want to take. The smart money is moving the other direction. And in markets, it pays to follow the smart money, not fight it. The Great Reset isn't coming. It's already here. It's happening in central bank vaults right now. The only question is whether you're going to participate or watch from the sidelines.